Good morning, my name is Patric Gresko.
And I'm Bjorn Tremmerie.
And we're here today at the Ugly Duck 2019 conference, which is the European Investment Fund annual VC conference.
And today we'll talk about the new funding approach of EIF in a new funding era.
And we'll explain how EIF plays a role as a market maker, as a market catalyst, as an access provider, and with the objective of answering the most pressing questions that the VC community has with regards to the role of EIF.
Thank you, Rachel. Good afternoon, ladies and gentlemen. Also, on behalf of Patrick and myself, a very, very warm welcome to Ugly Duck 2019. It is really an honor for us and a pleasure to welcome you with so many here in Luxembourg for our second Ugly Duck edition. We have just heard from Sylvia and from Marilyn how EIF is embarking on a new funding era. How EIF will be confronted with a new mix of tools, instruments, mandates, funding resources to support innovation and entrepreneurship in Europe. Now, we all know that change brings about a certain level of uncertainty. And you have sometimes wondered a bit what's going on at EIF. And Patrick and I have picked up these questions that you had and that were coming our way. And we will now try to give you an overview of the most pressing questions that we have picked up. I will try to give an answer and context to them in the next 15 or 20 minutes or so. So Patrick, what's the first question that sometimes came to mind?
Well, one of the most pressing questions we get here from the crowd is about the timing that EIF takes to process its investment proposals. And there was a guy standing here at this stage called Patric Gresko a year ago who talked about some fast-track process which would speed up the analysis of investment proposals. Well, we hear on the market that certain fund managers indeed have gone through this fast-track process, but the majority of them not. So why is that? Why is there this dual approach to the market?
Another question we've often been confronted with is, what about your ticket size? It's changing. You're investing less than last time around in my fund. Sometimes you're not investing at all anymore. What's going on?
The other question is about emerging manager. We hear EIF more and more often investing in the 6th, 7th, 8th, 9th generation of fund. But does EIF stay really true to its core mission to support emerging fund managers in emerging markets? Are they still backing first-time team, first-time funds?
You announced last year at your Ugly Duck last year that you're also raising private money now, and you're doing that. So am I actually competing with you for resources?
The other question is about terms and conditions. It was clear so far that EIF was the most demanding investor in terms of terms and conditions, going to lengthy negotiation process, asking for crazy alignment of interest. But at the same time, more recently, we have heard that EIF is getting a bit more softer and is accepting a bit more GP-friendly terms and conditions. So why, again, this dual approach? Why cannot we benefit from those terms and conditions and others do?
And some of you also wonder why we're still supporting established managers.
And finally, last but not less important question, EIF has been backing my fund for 2, 3, 4 generation of funds. They have been my anchor investor, they have been my supporter, but at this 5th generation of fund, they've decided to pull the plug, and this is clearly putting me out of business. Why are they doing that?
So these are all very, very valid questions. They're important questions that we should be able to address. I will attempt to do that now. But in order to start addressing those questions, we actually need to look at how the market has evolved and how the market looked like when we started our activity some 20 years ago, investing in venture funds. And the market has changed. Patrick, can you give us an overview of what it used to look like 20 years ago?
Yes, let's make a quick rewind back some 20 years ago. The market was characterized by some fund managers investing in early stage, slightly later stage, a bit more earlier stage, but the main distinguishing factor between all these fund managers acting on the VC scene was their team location. That was the main distinguishing factor between fund managers. But now, 15, 20 years forward, if we can move to the next picture, we can see that there is a plethora of players covering the financial ecosystem, supporting innovative companies. We see that every company, every city, every region has its own incubator, accelerator. We see the emergence of tech transfer funds. We have funds not only investing in ICT or life sciences, but we see funds investing in very narrow verticals, investing in cybersecurity, in blockchain, in artificial intelligence, as it has been mentioned before. We see funds now focusing only on later stage financing round, investing from the C rounds and beyond. We see funds providing not equity, but rather venture debt in order to support the underlying companies in a more diversified way. So there has been a plethora of players which appeared over the last 15, 20 years. And the role of EIF has been to adapt, proactively adapt, and provide proactively solutions for this complexified market over time. And as we have extended the tools in our toolbox to support the market, we have also extended the range of our market approach. We have modulated the way we are acting and interacting with the market players. And this is what Bjorn and I will explain you in the next 10 to 15 minutes.
So basically, Patrick, if I understand correctly, a one-size-fits-all solution doesn't do the trick any longer.
Indeed.
When we embarked in our support for venture capital in Europe, basically our mission was simple. We needed to develop the markets, make certain that venture capital funds got funded, and that was it. So we were a market builder and we were a market catalyzer, making certain that most of you got the funding to be in business. That reality has changed with the market, and now we actually need to tailor our approach. And we've done that by adopting 3 strategies. We will continue to be a market developer, making certain that certain market gaps get the funding that we as a public institution still need to support because it's not sustainable yet from the private sector perspective. We also need to continue our role of a catalyst of money to make certain that those funds that could attract some private money get sufficient money with our capital to be certain to have a viable fund size and strategy. But we also added now a strategy of pure access provider, where basically we make available pockets of money to the best funds we have to offer in Europe that would otherwise not invest in European venture capital. We'll now dig into each of these strategies in more detail.
So as a market developer or market maker, market builder, you can basically conclude that this is the traditional activity of EIF, is investing in undeserved market, in unproven GPs who do not have the track record yet and who do not have the history to be able to attract private investors' money. So together, not alone, but together with other public investors, we're still expected to represent 70–80% of the funds that we will be backing through this approach. And EIF will continue doing so. You've seen the figures in the previous slide. That should represent, or we're expecting that to represent some 10–15% of our activity going forward. But we will continue applying a very demanding due diligence process. We will continue be very demanding in the legal negotiation process in terms of terms and conditions, in terms of alignment of interests. Why? Because our objectives is that over the long run, these players will be able to fly with their own wings without a massive support of the public investors. And that's why we see ourselves, our role as preparing them to fly on their own. So going forward from that strategy, what can we expect as an access, as an investment on the market? We'll be particularly paying attention to markets which are underserved currently. And from a geographical perspective, the snapshot today that we have from the market is that Southern Europe and Central and Eastern Europe deserves a further push with the support of EIF and other players. From a sectorial approach, you've heard it about from Pierluigi, from Marilyn and Sylvia who have presented that. We have seen the emergence of strategic sector for Europe like blockchain, artificial intelligence, cybersecurity funds. And from a stage perspective, we also have identified gaps that deserves a specific support from EIF and other players. On one side of the spectrum, technology transfer accelerator, but on the other side, the support for later stage funds, which will be financing companies which are raising 100–200 million euros and who cannot get finance in Europe because of the lack of European players able to provide capital to this type of companies.
Moving to the market catalyst role that we adopt, this will continue to be the bulk of the activity that we do. The bulk of the activity will consist for us as a public sector funding provider to complement the private sector where needed, because the private sector is not sufficiently available yet for those players to bring their fund size to the right target, to bring it to the right target to execute successfully their strategy, or even to have a viable infrastructure. We will not only focus on the southern or eastern peripheries, it's also important to continue to play a market catalyst role, attracting private money next to our public mandates to make certain that the markets get funded also in the mainstream, more developed venture capital markets of Europe, like the Nordics, like France, like Germany, like the Benelux, like Spain. We will continue to also be present there. What we will do, however, is we will tailor our intervention so that on the one hand, by investing public resources, we're not crowding out the private market, but we're also not underinvesting in areas of need, so that at least you have a success rate that is manageable and achievable, so that it's not a suicide mission to launch your project. That we will continue doing. But it's also important for some of you to notice and to realize that we're not here to keeping artificially alive fund managers. If you have received 2 or 3 times our money, and at the end of that observation we say, hey, where's the performance? What have you done? And we're not convinced, and the market is also doubting, we cannot intervene with Darwin. We need to make also the Darwin approach happen and say, we're going to take a rain check on this fund. We're not going to invest this time now because we are not convinced. And we'll give another kid on the block a new chance. That is also our role. Now, we may get it wrong. And if we get it wrong and you're still in business and you show bounce back ability, we will re-engage with you and continue funding you. So that's also the role. What we will do here is terms and condition-wise, we will make certain that we are protected. We are sufficiently protected. It doesn't need to be with the triple, quadruple parachute as like in the market building approach, but we need to have some protection because the private market is not fully endorsing you yet. So there will be some more friendly and unfriendly terms there, but it will be a good mix. And typically, we will take the role that gets you into the space that you want to be.
And finally, to the third role and the most recent role of EIF, which is the access provider, as we call it, or the market access. You will all agree, and you've seen that from the previous presentation, that the market has matured, and with this high level of maturity, we see a growing number of fund managers which are able to display a cash-on-cash performance, which turns the asset class as very attractive. We're talking now about more than 50, 60, 70 VC funds across the market who are having a double-digit net AR. This is, of course, attracting the attention of potential investors. And those potential investors, who are they? We see pension funds, we see insurance companies, we see sovereign wealth funds, we see corporates who would like to have an access to these best players in class on the European market. But they do not know how to do that. Either they don't have the infrastructure, it's too costly, they don't know where to start. They have too deep pockets. We hear about pension funds which have billions to invest and they don't know how to deploy a 10 million or 20 million ticket in a VC fund, or they're too small and they would like still to have an access to those VC funds and they cannot do that, or they're too remote from the market. They don't know this fragmented European ecosystem. They don't know whether they should start in the Nordics, in Germany, in France, or in other peripheral areas of Europe. And the role of EIF is to provide an access to these new players, to the best players on the VC market. So this access provider is not only about providing an access to these external new investors to the VC asset class, but is also for our best performing funds, providing them with an access to players which otherwise, without the support of EIF, they would not be able to get into. And of course, we're adapting ourselves to the good performance and the maturity of those fund managers. We cannot apply terms and conditions to those players who have been there for 8, 9 generations of funds. We cannot apply the same terms and conditions and the same requests than the first-time team, first-time funds. So going forward, you will see that the level of demand in the legal negotiation of EIF will be modulated in order to reflect the maturity of the funds that we are looking at. And as a matter of fact, we're also expecting for these fund managers that the investment of EIF will gradually decrease over time, because we're very worried that we don't want to crowd out the private market.
So we haven't forgotten about the questions that we put at the beginning of our intervention here. But did we actually answer them? So let's try to have a quick check. Patrick, are we on timeline? Why are we sometimes faster and sometimes slower?
Thanks for that question, Bjorn. Well, we're improving. As I said last year, I can only repeat that. We're doing our utmost to improve the timing of our analysis of the investment proposal. And clearly there are a growing number of players in this crowd who have enjoyed this fast-track process where we have managed to leverage a long-standing relationship with those fund managers. But as a matter of fact, for fund managers which are not known to us, emerging players from emerging markets with whom we haven't had any prior relationship, it takes time. But it will also take time for those players who have been there for several generations, as Bjorn has explained earlier, several generations in our portfolio, but who have not been able to demonstrate the performance that we were expecting. So we will take a bit more time before doing this very tough conclusion and pulling the plug on those players that we have been backing historically. The other question for you, Bjorn, is about ticket size. Smaller, bigger, where is the EIF going?
Well, it's going in the direction of where the market is going. We will adapt our ticket size to the need that we have in the market. If you're fully capable of raising private money, we just want to be in to give private access to private clients to your fund, and we will not crowd out the private sector. But in some cases, we will put a larger ticket in, because without the larger ticket, you may not get your fund off the ground, and you have a strategy that we think should be getting off the ground, and we will help you in doing that. So we will tailor our approach to the reality, but we also need to be aware that the market has developed. There's more players there now that could benefit from our support, and we also need to spread a pot of money over more players. Patrick, you were also wondering why we're still supporting the emerging managers.
Well, clearly, you've seen the statistics of Uli earlier. We have a great statistics and great performance in supporting emerging players. We'll continue to do so, 10 to 15% of our activity going forward, but with a slightly different approach than in the past. We will pay a crucial attention that any proposal that we'll be analyzing is clearly corresponding to a market gap that we have clearly identified. So if the proposal that we're looking at, despite they're coming from emerging players, is not bringing anything new to the market, we will come most probably to a negative conclusion. So we are paying a particular attention to filling the gaps, and it's a much more complex exercise today, given the complexity of the market, than some 20 years ago. Next question for you, Bjorn, was the competition of fund managers are telling us that we're competing with them in their fundraising because we're stealing the corporates into our AMUF vehicle.
We don't think we're fishing in the same pond. We're making available pockets of money that would otherwise not invest in venture capital funds in Europe directly, either because they are too big in scale, too small in scale, don't have the expertise, either in Europe or the skill set to do fund of funds. Patrick, back to you. Why are we sometimes offering friendly terms and sometimes unfriendly terms to GPs?
I don't think it's a question of being friendly or unfriendly. We have plenty of friends on the market, but there are friends that we know better and friends that we know less better. So with regards to the fund managers that are known to us, we will be demanding in terms of alignment of interest, in terms of terms and conditions, not only to protect ourselves, but also to prepare them for the next generation of fund when they will be fundraising with private investors. And this is the role that the market is expecting us to play, to provide this quality stamp, quality seal for fund managers, which afterward they'll be able to leverage in their private fundraising market. With other players with whom we have a relationship of 15 to 20 years, where the fund manager has delivered well beyond our financial expectations, of course we will be ready to accept more GP-friendly conditions. Finally, one more question to you, Bjorn. Why are we supporting established fund managers?
Why are we supporting established managers? Well, we actually don't. support established managers anymore. They don't need our support. We invest in established managers with pockets of money that want access to the best of the best. So our role there is not anymore one of being supportive, but one of unlocking pockets of money that would otherwise not invest in Europe, and we give them access to the best established managers in Europe. And the final one I think we had up for today was why we sometimes stop investing in fund managers.
Well, simply because it is not our role to keep alive fund managers who have been there for 10, 15 years, raising their fourth, fifth generation of fund without demonstrating a financial performance. We are not there to keep those players artificially alive. If they don't get a minimum level of support of private investors, will not hesitate to pull the plug, because we have to play, as you mentioned, Bjorn, this Darwin effect on the market.
So with that, ladies and gentlemen, Patrick and I are convinced that we did answer the questions. If not, come back to Ugly Duck 2020 or come speak to us at one of the coffee or networking breaks. Thank you.
Thank you very much.